Jackson Hole Confab 2023, 2020, flexible inflation averaging framework change, 2021 transitory, which led to a quick pivot in December of 2021, 2022 pain in the U.S. economy, which really didn't come to fruition, 2023, make no bones about it, 2% is 2%, something we've clearly written about over time. It really would make no sense for the Fed to change that inflation target coming out of transitory and getting that level wrong with a new framework 5 years down the road. So 2020, 2025, just when the Fed is expected in their summary of economic projections to get down to 2%, we will have another framework change in 2025. A lot of chatter on the neutral rate, this enigma. Historically, no surprise here, really, Powell has kind of shied away from knowing where this neutral rate is over time. Look, the bottom line is the real economy is going to tell the Fed how restrictive they are or not. And as of late, and as Chair Powell referred to, the Fed needs to be attentive to growth here picking up. He mentions the housing market showing signs of bottoming and now doing better. We know there's a lot of inflation coming out of the housing market, so that warrants attention. The Atlanta Fed GDP tracker now above 4% for the third quarter. Inflation coming down, but with nominal GDP still running high. In fact, where is this economy? What are the risks of inflation going forward, i.e. the risk management approach that the Fed is in? Now, we have pointed explicitly over time to the fiscal side of the equation, the deficits and spending that we are seeing coming out of Washington right now that more than likely has that R star elevated, i.e. a little bit of frustration on the part of the Fed. And you could hear it in Powell's message and speech that the Fed has raised rates a lot here. They've done everything that they've done historically, and they've moved real interest rates significantly higher. Of late, 10-year real yields moving 80 basis points higher from May of 2023 to where we were recently, close to 2% in 10-year space. Yet at the same time, we're looking at the economy, which is proving to be fairly resilient. There's a lot of money still coming from the fiscal side of the equation. We can't stress that enough. It's keeping nominal growth very, very high, and there are risks clearly to inflation going forward. The Fed certainly in risk management mode here. The message very clear, 2% is 2%. But it will take time, which bodes for the Fed tweaking rates higher if they need to. We favor November versus September in a risk management approach. And also, it's now about the length, not the height, higher for longer, something this market has not entirely embraced. We had rate cuts in 2023, which now have only gotten bumped out to 2024. And that remains to be seen. But this Fed is committed to getting inflation back down to 2%. It does not mean they will go higher and higher. And I think Powell stressed that. They are in risk management mode. And risk management mode means they're going to watch the data. If they need to skip meetings, they will skip meetings. And if they come to the conclusion that a 5.25% to 5.5% Fed funds rate and where real rates are at that time are restrictive enough, then they will stay on hold, so long as they are convinced that inflation is coming convincingly down to 2%. And by the way, the dialogue will also change over time if inflation does continue to come down into 2024 as the Fed remains on hold or slightly higher, that they are becoming more and more restrictive along the way. This is a message that we heard from New York Fed President Williams. It will be an important message if inflation continues to cooperate and come down. If we bottom and start to rise back up again, then certainly at a minimal, it will be higher for longer, with the potential also for the Fed to tweak higher if they need to. And Chair Powell was very, very clear about that. Wishing everyone a great weekend, looking ahead to next week. Obviously, a week ahead of the Labor Day holiday weekend, but we do end with the employment number on Friday, looking at claims from yesterday, looking at continuing claims. We sent a chart out to clients. Continuing claims are still showing a certain level of resiliency here with regard to the labor market. Have a great weekend. I'm Greg Faranello. I'm head of U.S. rates for AmeriVet Securities.